Chapter 5, Unemployment. Section 2, Labor Market Indicators. No single labor number can tell you the whole story. Unemployment, hiring, participation, wage growth, and job openings each capture a different part of the market, so investors get a much more reliable read when they look at them together. 3 indicators form the core of labor market analysis. The unemployment rate tells us how many people in the labor force are jobless and actively looking, while the participation rate and the employment population ratio widen the lens to show how connected the broader working age population is to work. The unemployment rate is narrower than many people assume. It counts only those in the labor force, meaning people without jobs who are actively searching, so someone who wants work but has stopped looking is not included as unemployed. That is why the participation rate matters so much. It asks a broader question: out of the whole working age population, how many people are either working or actively looking, which helps reveal whether low unemployment reflects real strength or just fewer people engaged in the labor market. The employment population ratio goes one step more direct by focusing only on who actually has a job. Because it does not depend on whether someone is actively searching, it can uncover hidden slack when unemployment looks unusually low, but a smaller share of adults is working. Once you know how many people are working and participating, the next question is how tight the market feels. Faster wage growth, lots of job openings, and a high quit rate often point to employers competing for workers and employees feeling confident they can find something better. These headline numbers come from careful survey work, not guesswork. Each month, the Bureau of Labor Statistics surveys households, classifies people based on whether they worked or searched for work, and then uses seasonal adjustment to make month-to-month comparisons more meaningful. Good analysts do not stop at the headline unemployment rate. They cross-check it against broader measures like U6, payroll growth from the employer survey, wage trends, and JOLTS data on openings, hiring, and quits to see whether the story really holds together. A good example came in July 2023, when the U.S. unemployment rate was just 3.5% and looked extremely strong on its own. But participation was still below its pre-pandemic level. The employment population ratio had not fully recovered, and wage growth remained elevated, suggesting a labor market that was tight but not fully healed. A simple worked example shows why these measures belong together. If 400 people are employed and 600 are unemployed, the unemployment rate is 86%, but the participation rate is 70% and the employment population ratio is 64%. And those differences matter when you interpret the economy. It also helps to avoid common mistakes, like overreacting to a single month, or ignoring discouraged workers, involuntary part-time work, wages, openings, and quits.